So as you can see from the video, this year we are celebrating our 20th year in operation. So as part of those celebrations, we have 3 gift hampers just at the side. So they'll be drawn at the end of this by a random generator for the names that have registered. So please stick around to ensure you're in the draw to get one of those 3 hampers, fingers crossed. Our presentation, let me just get going. Okay, our presentation is a little bit behind, but we've done that for the parking. So we are aiming to finish just after 7 p.m, to which we will then have a panel. So we'll be going through some questions that people have sent in, as well as anyone who has questions in the room, feel free to ask at that time. We'll have some people with roaming mics, so you can put your hand up and just ask one of us a question. So food and drinks will be served at about 7:15, so feel free to go back to the lobby area and have a drink, have a food, and our consultants will be there for a chat if you do have any questions. If you do need to use the restrooms, they are just out to the left, so walking out that room and then down the back there. At the end of the evening as well, there'll be a QR code on the screen. That's there for you guys to scan into your phone, complete your questionnaire, and then you'll be in the draw to win a $250 Coles Myer voucher. So that's going to someone in the room tonight, so you'll have about a 1 in 90, 1 in 100 chance of winning this, so highly recommend you do that for the couple minutes it takes. And if you don't mind, if you could put your phones on silent if they're not already done so. At the end of today, you'll all be given a free copy of Damien's best-selling book, Property Investment Roadmap. They will be at the registration desk, so on your way out, make sure you grab your free copy. There is also accompanying a podcast with this, where Damien and guests will dive into each chapter of that book to get further explanation and context to some of the examples that are in there. That is available on all streaming platforms, so feel free to check that out. We're currently recording season 3 of our podcast. So that is being sent in by people that have listened to the first 2, have a bunch of questions, and we're diving into those questions on season 3. So feel free to check that out. And if you're someone who might be stuck in traffic every day like me, there is available on Audible as well as Spotify Premium. So if you guys want to just purchase it instead, feel free and you'll be able to check that out. During the seminar as well, there will be some statistics on the screen. When you see those statistics with a circle around it, that is coming from our annual sentiment report. So we send this out to property investment people, people in our audience, people that have attended, purchased, whoever wants to fill that out to get a feedback of what people in the broader community are thinking about property and where it's planning to go. So you'll be given a free copy of that in the next week as well, into your inbox. Our presenter is Damien Collins. So Damien, just here to your right, is a highly respected and sought after commentator on both residential and commercial property markets. You may also recognise him from his time on TV during 2018 and 2022, when he was the president of the Real Estate Institute in Western Australia and providing a lot of commentary to navigating Perth during COVID and the uncertainty around property at the time. He is the founder and managing director of Momentum Wealth and the chairman of Westbridge Funds Management. Both businesses are designed to help clients right through their journey at every stage. Welcome, Damien.
Thanks, Robin, and hopefully you can all hear me. Apologies, I don't control the traffic at Crown, but apparently there's a few other events on, so sorry about that. But we've got lots to get through tonight. Probably closer to 7:15 by the time we get to the questions and answers. So tonight, go through a bit of an introduction. Diversifying with purpose, investing with clarity. So why do we want to diversify our property investment portfolio? But when we do, when we make that decision, investing with clarity, knowing exactly what we should be looking for, the types of investments, the locations. So we're going to cover that. What does Perth still have to offer? Obviously, we've had a fantastic run here in Western Australia, and particularly in Perth. Is there still anything left in this market? For how long? How much growth is still here? And then if we were going to diversify into another location around Australia, where are the opportunities? And we'll go through all those markets, the key markets around the country, talk about where we see the opportunities in this stage of the cycle. And then I want to talk just a little bit at the end about commercial diversification. If, as Robin said, everyone will get a book, so no need to rush out. There is more than enough books for everyone to get one. But in the book, we talk about commercial diversification, and the reason is residential is a great place to start, but commercial is where you want to finish, and I'll talk to you about tonight about that. And then about 7:15ish, we'll have Robin and Caleb up for a panel discussion questions. And if we don't get to all the questions in here, you're welcome to come and talk to us outside and ask us further questions as well. So, Robin said, Momentum Wealth, 20 years. We'll reach that milestone in August. Remember very much, we started up in East Perth, a small team, and really thrilled about how we've gone. And the reason we're thrilled about it is because we've seen so many clients have great success from investing in property. Got lots of clients on their second, third, and even further on in their property investment journey. And it starts with that property investment strategy. Everyone's unique in this room. Everyone's got their own circumstances. So it's about a property investment strategy, designing what's right for you. Then, of course, most of us, if we can't borrow money, we can't buy an investment property. So that's critical that we've got a finance team who can help our clients, and they're very experienced, particularly in more complex situations. A lot of our clients use trusts and other structures, self-managed super funds. Our team are experts in investment in property. Buyers agents, our team go out there in the market, buy the best possible investment properties or the best homes. We do represent people, home buying space as well, managing that property effectively. And at the end, if and when your time to sell, and there might be a time to sell for a whole variety of reasons, or it's just scaling down residential, building up more commercial. We're not a seller's agent, but we work as an advisory service to help our clients get their property sold through selling agents. So there's two divisions of our group. Momentum Wealth is designed for starting out. So it's about when you're looking to first start building wealth through property investment. Generally, we start in residential. It's about setting goals. What do you want to achieve? How are you going to get there? Understanding the property market. You don't have to be experts, obviously relying on us, but we find clients who have a good level of understanding about investing in property are more confident in their decisions going forward. Of course, that dovetails around finance. Without the mortgage and ability to get a loan, it makes it a lot harder to, of course, build that property portfolio. So that comes together, and then building and continue to build that wealth accumulation phase. But when you get towards the back end of your property investment journey, that's when commercial property starts to make more sense. It's a better, high-yielding asset class. It does come with some risk, which I'll cover off tonight. But if we want to live off the income from our properties, and as I said, that was the topic of the book, Building an Income from Property for Life, you do need commercial exposure because that provides a better cash flow return. So we've been thrilled that we've purchased more than 2,000 properties, $2.5 billion in loans, and we've got asset management in Westbridge about $1 billion. So we're really thrilled that we've been able to help that many clients through that journey. So the topic, diversifying with purpose but investing with clarity. That's what we're here to talk about tonight. So just before I get into it, I guess everyone here is here for a reason, because they want to invest, right? I'm sure no one here is not thinking about investing in or building wealth through property. So just out of curiosity, and some of us are over 50 like me, so this won't be applicable, but who wants to retire 50 or younger? Anyone? Couple? Yeah? What about between about 60? Anyone want to go to 67? No one. Okay. Well, sadly, for the vast majority of Australians, that's where they end up. 67, that's now the pension age, if you want to get to the age pension. And that is the outcome for most people. And why is that? Let's look at a few scenarios. If you don't invest, let's say you're self-employed all your life, you didn't have to put any money into superannuation, you paid off your home, you had a small business, maybe you're a plumber or a tradie, and you wanted to retire, you're basically stuck until you get the pension. And when you get the pension, it is $42,000 per annum for a couple. Now, I don't think anyone in this room would like to live on $42,000 per annum. Maybe $42,000 a month, but definitely not $42,000 per annum. But that is the reality for someone who's been in that situation. Now, there's less people in that situation now because we've had super. So, the media tells us superannuation is great and it's, going to help us all in retirement. And it does, absolutely. Having super is much better than having nothing. But the average super balance for a couple right now is $320,000. Now, that's not a lot of money when you, again, if you've got 320,000, you really can't retire until 67, because if you had retired with 320,000 at 62 and you burnt through 50 grand a year, that's going to run out before you even nearly get to your pension age. So you're really still stuck working right through to 67. And yep, that super's great. It's great to have super. It's going to give you 320,000, will give you about 17,000 per annum over 20 years. So you still get the full pension with that level of assets, but you're only up to 59,000. Now you're better off than not having super. You've got your home, but again, 59,000 is not a huge amount of money if you want to travel, buy a nice car, and do all those things that people would like to do when you've been working your whole life to get to that goal. So super's a help, and yep, lots of people put more money into super, and that's a good thing. So good, but most of us will not get to a substantial level. Now, younger ones in the room, when I started work, it was superannuation was there, but it was only 4% or 5% back then. It's now gone to 12. So people in their 50s probably don't quite have as much. Younger people will definitely have more. But the other issue with investing is this really difficult spot where you think, gee, I've worked hard, I've saved, I've got, whether it's super or an investment property, I've done what I needed to do, and so yeah, I'm comfortable. I think, well, I got 300 or 400 in super, investment property worth $1 million that maybe I've paid off in full. I've got $1.3 million in investments, but the problem here is that there's such a thing called an assets test and an income test. So if you have too much money, according to the government, and it caps out roughly, I think it's just under $1 million. If you have $1 million of investment, and that includes super and your investment properties, your pension goes to zero. So it starts to phase out, I think, 400,000, and then it phases out in totality by the time you get to 900,000. So that's not really the spot you want to be. Now, are you better off than someone who's got no investment property? Absolutely. You're going to still be better off, because at least you have a choice, rather than if you don't live off the income off that property, you can at least sell down that asset and live off the capital over time. But if you want to keep that income from that investment for life, and you don't want to sell it, well, again, you're still stuck. You're not going to get a huge income stream from your super and just your investment property. So our philosophy is, well, you know what, let them have their pension. You know, if you're relying on the government pension, it's 67 now. If you're 40 or younger, I doubt it will be 67 by the time you get towards that retirement age. It could well be 70, could be even higher. As our life expectancy continues to grow, we know that they're spending more money than they're bringing in. There's a budget deficit. They're going to have to make some decisions, whether it's now or 5 or 10 years. So I think people under 40, definitely, even under 50 are at risk. They will continue to kick that age up. It has been proposed to go to 70. They didn't follow through on that. But reality is, yeah, one investment property is probably not going to give you that lifestyle that you want. So our philosophy is, well, let's forget about that one investment property. Let's go to multiple investment properties. We don't want their pension. They can have it. The pension there is a safety net. So if things go astray in life, you know, we can't work or something happens, at least it's a safety net there, but we don't want to aim for that. We don't want to aim for that pension. Let's aim to have enough investments in our life that we can live off the income from that. And then worst case, if you can't live off the income for life from your investments, you can start selling down some of those assets and using that capital to draw down on as well. So at least you've got choices. You don't get a pension, but you have choices. And so many in the room said they want to retire by 50. Pretty much everyone else was 60. No one said 67. You want to be in category 4. Otherwise, you're not going to be in that position without those multiple investments or multiple investment properties, if property is what you particularly want. So, but of course, when we're investing in property, it's generally a lumpy asset. So we want to be focused on, well, how do we manage the risk as we're building out our property investment portfolio? And that's what diversification is. And it applies to shares and everything else, diversifying your pool of investments so that they all don't go in the same direction right at the same time. It's great if they're all going up at the same time, but if they're all going down at the same time, that's problematic, particularly if it's at the stage of life when you're retiring and they all go down in value. So you want to make sure you've got a diversification of assets across, and I'll talk about how we diversify so that one might go up, one might go down. Our volatility is lowered by having that diversification, and we're lowering risk. Diversification generally does lower risk. So what is the foundation of lasting wealth? Yeah, you want to manage your portfolio and your property risk, being cautious about exposure to certain kinds of risks. And again, that'll depend on your personal circumstances. Sometimes it's worth taking a bigger risk if you've got the risk appetite to deal with any downsides that come with that higher risk. And managing government risk, yeah, look, governments around the country do different things with their laws, and I'll talk about Melbourne a bit later on. Tax efficiency, if you buy all your properties, for example, in Perth, and you just bought them in your own name, and you had 5 or 6, you start to get really smashed with land tax. If you bought one in Perth, one in Melbourne, one in Brisbane, they all treat their land tax jurisdiction separately, so you would pay a lot less in taxes. So it's about tax efficiency as well. So it's about, yeah, being a safer approach to building out a big portfolio, not putting all your eggs in one basket. So how do we diversify? Well, there's lots of ways. We can diversify geographically. So that doesn't just mean another city, it's even within your own city. So I'm surprised about how many people buy, if they've got investment property within 5 kilometres from their own home. And people think, well, I know the area, I can drive past it, that's nice. But if your particular area, for whatever reason, doesn't perform particularly well, it's likely that the investment property you bought as well is not going to perform as well also. So really, even if you're staying in Perth and you already got a home in Perth, you don't want to invest in your suburb or near your suburb. You want to invest in a good area, but that's still got strong potential for capital growth, but not necessarily close to you. So that way, again, you've got diversification. If one market performs better than the other, again, it could be regional, a regional market. That's generally not for your first investment property, but it could be a regional market. And then, of course, as I say, interstate diversification. That's probably the broadest geographic diversification. And then the types of properties. So what's properties higher risk? Generally, development opportunities where you're planning to develop, they could be the higher risk, but potentially higher return as well. But if you're in a lower risk phase of your life, you might go, I've already got a couple of riskier properties. Maybe I'll go to something that's newer, good land value, but not 80%. It might be 50%. You're getting good investment returns from rent, getting some depreciation benefits. So the types of dwelling can also help diversify your portfolio. And the type of purpose, some might be for short-term investment, higher, longer-term investment, and then other macro factors as well. Talking about, as I said earlier, some of the legislation issues around the country. And interestingly, Robin mentioned our property investment survey. So the results are coming out. I believe you guys are all going to get sent a copy of that survey. 56% of investors in WA said established houses were their first choice. And that's actually pretty logical. We generally do like houses because they have a high land component value, not just the size of the land component value. So interestingly, a lot of investors certainly do prefer the house as their preferred investment. Look, when we're investing, looking around the country, we like to invest generally in the capital cities. And why is that? Well, generally there is a lot of economic diversification. So if you invest even, for example, in Sydney, financial services market, high in tourism, strong in education. Melbourne, quite similar, probably less strong in financial services, but it's the industrial trade hub of Australia. Most goods coming into Australia come through Melbourne, certainly more than anywhere else. And Melbourne's the biggest industrial market in Australia, about 30 million square metres. You've got better access to supporting services. You've got people who are there's property managers, repairs. I know people in regional areas just cannot get any trades whatsoever because they don't exist. And price stability. Typically, the capital cities are less volatile. Doesn't mean they don't go down. There'll be times when they do go down, and we had a market in Perth where we went down 15% or thereabouts. That was painful, if you remember back 8 to 10 years. Generally, though, capital cities are less volatile. Some of the regional areas, if you went into Port Hedland in 2012 and you bought one of those properties at $2,000 a week rent, looked to you like you thought it was, this is great. I'm getting $100,000 a year on a $1 million property. Well, when that market fell, it fell bad and the prices dropped to $200,000. That's an 80% hit. People who had multiple investment properties in some cases were wiped out, bankrupt, lost everything. So do you want to go to one of those markets? Well, we actually have been buying and bought a lot of properties up there a couple of years ago when the prices were closer to $200,000. It's come back a fair way, but they're the sort of things that are more speculative investments, and so it wouldn't be putting your first investment property in one of those towns, and you've got to understand those risks. The other thing too is understanding the market. There's a lot deeper market in the capital cities. There's a lot more people. Understanding the sales data, there's a lot more transactions, so you get to understand those markets, and liquidity as well. If you're in a small regional town and the market turns bad, you can't almost give it away. There's just no buyers, whereas in the city, there's always going to be buyers. Yeah, you might have to drop your price a bit, but you're not going to be stuck holding an asset. If you really want to get out, you can actually get out of that asset class. So I mentioned before, what are the types of investments? Historically, we prefer houses, but doesn't mean townhouses and villas and units and apartment can't have good investment returns. They're more likely to have better cash flow. But even apartments, if you buy an apartment that's an older style complex, low maintenance, you can still have a strong implied land value, even though you don't have a plot of land necessarily in your apartment. You actually have an implied land value. So whatever price you're paying, there's always an implied land value. So yeah, they're the sorts of, again, but that'll come down to your individual circumstances. What sort of investor you are. Are you a blue chip investor? Are you an aggressive equity builder? That'll help determine what sort of assets that are most suitable for you. Just interesting too, like the difference in performance. So across, and this is why we generally like houses and properties in established areas. So if you bought property in the last 30 years ago in Perth, of course you've made money. Everyone's made money, but some people have made a lot more money than others. And this was a type of investment out in Canning Vale. This would have been 30 years ago. Would have been, you can see Southern River just below it. This would have been generally a first home buyer area back then. So we would have seen the first home buyers building out the house and land, and that kept going, and then they filled out Southern River, although that was later than Canning Vale. So you think 455,000, pretty, it's got a good rental yield there. That's maybe not a bad investment, and if you'd made 455%, you're thinking, well, I'm pretty happy with that. However, if you'd gone to Waterman and had a look there, right up in that Trigg region, Sorrento, the 30-year growth rate was 1,390%. So those two people invested at the same time. One went to Waterman's Bay, one went to Canning Vale. The person who went to Waterman's Bay is sitting pretty and has made a lot of money. Having said that, now, if you're buying, the rental yields are pretty appalling. It's 2.33%. And so by the time you pay your expenses, you're getting close to maybe 1.2, 1.3% yields. So very low yields. Now, will it perform well? Yes, it will. It's a water-based suburb. But will it perform as strongly in the next 30 years? Probably not, but it's still a solid performer, but the rental yields are not very strong. So there's always a trade-off. Generally, the higher the rental yield, the lower the capital growth, or expected capital growth. Doesn't mean it can't be strong capital growth, but the expected capital growth tends to be lower. So, and here's another one, so a bit more balanced. So Heathridge was, at that stage, was a first home buyer area, but it had been more further built out, and that's performed at 763% over that 30-year period. So, and the rental returns would have been much better than you would have got in Waterman's Bay. So everything's a trade-off. The higher the growth potential, generally the lower the rental yield's likely to be. Vice versa, the higher the rental yield, the lower the potential capital growth is likely to be. So very much thinking about that. What's the asset that you want? If you can afford that negative cash flow, well then, yep, you should think about going into a higher potential capital growth and lower yield location. Again, that comes down to you. Interesting also in that survey that you'll get a copy of, 1 in 2 investors prefer a mix of growth and income, and particularly in the over 45 age bracket. And that's what I was saying before. People, as they get older, they start to think, gee, I love my investment properties, but, well, I need to get some income from these eventually. And so that's where the income starts to become more important, particularly for people as they age through that journey. So why would we go interstate? Well, there's some good reasons why we wouldn't. There's also some negative reasons as well. Negative risk, I should say, not reasons. Why would you do that? If you bought into an upcoming upswing. Of course, now that's always the thing that we all love to do, isn't it? Pick the exact bottom of the market. That's very rare that people can pick the exact bottom of the market. So, but you might get that early stage upswing. Now, it's still really important to be choosing cities and locations that have got great long-term potential, right? I don't want to buy into a market that's going to upswing 30%, but in the long run, it's a bit of a dud, because by the time you pay your entry fees, stamp duty, your exit fees with sales agents, and your capital gains tax if you sell, it's not worth just buying a market going into an upswing just because, unless it's got good fundamentals long-term. So that is a critical thing. Must be a good long-term market, but you can buy at the right stage of the cycle. You can get that free kick. You might get that first 30%, still a great long-term investment, but you bought at the right stage of the cycle. And we saw that in Perth. If you go back, in 2018-19, we were certainly, when I was REWA president, but also in our business, we're saying this is now ridiculously cheap in Perth. It's just crazy that we're $450, and a lot of Melbourne or Sydney particularly was 1.2, 1.3 or whatever it was. So we were ridiculously cheap. We obviously had a fantastic upswing if we bought. And so a lot of that upswing has come. There's still a bit left, which I'll talk about in a minute. But there are other markets around the country where still fundamentally long-term they're good, but they're in that early stage of starting an upswing. So we'll talk about that. So it's a nice extra free kick. You wouldn't just invest because of the upswing, but it's a nice free kick if it's a good long-term investment. Location, economic diversification. So we are clearly a mining and oil and gas town. At least we do have, unlike some, I think of Houston in the US, that is just an oil and gas town. And if that commodities go kaput, that whole town is boom and bust. At least we do have gas. We have iron ore. Well, now with lithium's getting better again after a bit of a hit. Gold. So we are a more diversified, but we are still a commodity-based economy. If I go to Sydney and Melbourne, they're really not impacted by the commodity cycle. Melbourne is very much about tourism, particularly education, financial services. So it's a much broader. It's one of the lots and lots of foreign students, and at the university. So quite a different market to us. So that's why if you look over the cycles, that market doesn't go the same rate as us. It tends to go in different cycles. And it's obviously dealing with the political and regulatory risk. There's some laws that come in around different places around the country. If all your properties are in one state, you might find that you're then got a lot of regulatory risk. Whereas if you've got properties in different capital cities or locations around the country, then that minimises or lowers your regulatory risks. But of course the challenge is, if you go to another capital city, well, how do you know the market? How do you know what's a good place? You don't have the local knowledge. There are lots of markets, and there's 5 million people in Melbourne and a bit more in Sydney. There's hundreds and hundreds and hundreds of suburbs. There's 360 suburbs in Perth. Melbourne and Sydney have even more than pretty much double that. So there's so many suburbs. How do you get that information and data? Understanding the laws about how their tenancy systems work, and obviously you don't know the tradespeople. You haven't got local contacts on the ground. So there's a bit more to consider. There's pros, but there are also some risks as well. So interestingly, we find so I got a media inquiry today from the West, which will be in the paper tomorrow. Has the Middle East had any impact on our investors? And generally the answer is no. I think we've had one or two just saying, I'm going to park it for a minute. People get very much let the short term influence their decisions. And we're all human. We'd love to be just completely unemotional about our investment decisions, but we're not. none of us could, with some of us can say we think we are, but generally deep down we're not. There's always an element of emotion. And we see that in the market at the moment. So FOMO, fear of missing out. Robin heads up our buyers agency division, and he can tell you, him and the team out there see people doing stupid things. They just don't want to miss out. They'll overpay by 100 plus thousand, right? You don't need to do that. The market's strong. You don't need to overpay 100,000. So making sure that is not impacting your emotional decision. And then you get the other side, with people fear of overpaying. They overanalyze things. You know, what's the market going to do next week? What's going to happen if interest rates rise? They went up today. We know that. What is going to happen? If you get what they call analysis paralysis, you overanalyze it, you overthink it, and the perfect property doesn't exist, and the perfect time doesn't exist. So you make well-informed decisions, but there's always an element of uncertainty to it. So don't get, and I've seen over the journey, more people lose more money by sitting on the sidelines than I have seen by people who maybe go in, and even if they overpay a bit, they generally, if they're long-term investors, that'll correct itself. But people who don't invest in the market, I remember a lot of people, 2019, don't buy property, then COVID hit, definitely don't buy property. Well, they've missed on 80+% capital growth over their journey. So, and a new buzzword that Robin came up with, I can't claim credit for this one, COMO, compromise or miss out. You, again, looking for that perfect property, it doesn't exist in this, you know, it's one that's perfect for you, but it may not be the completely perfect property. So, you know, there's always going to be something about it. And remember, when it's an investment property, you're not living in it. So what you would like in a property isn't necessarily what the market cares about. So in some locations, 3-bedroom, 1-bathroom houses are perfectly okay. Now you think, oh, geez, I don't want to live in a 3-bedroom, 1-bathroom house, but they're perfectly okay in some locations. So you've got to be prepared to compromise, otherwise you're going to miss out in this market. So when do you want to diversify? Starting out, we want to focus, as I say, on education, strategic planning, goal setting. What's the right strategy for you? What sort of investor are you? And that's generally why we start with residential. And why do we do that? Because residential is something that we can generally borrow a large proportion of the purchase price. That makes it easier to get into. It's generally lower risk than other asset classes in property. So that's where we want to start. Generally residential property. And then we might do some value adding as you build that property portfolio. But when we get to that back end, particularly when you get to 50 plus, really got to be focused on more cash flow because you want to live off that income for life, ideally. So that's when we want to start thinking about commercial property and commercial property funds. Again, talking about that fear of overpaying and sitting on the sidelines. The market's going to go up and down. What's it going to do in the next decade? No one in this room can tell you. I can't tell you. But I know historically, while we have a strong economy, population growth, growing wages, our prices are going to definitely be higher over the next 10, 20 years than they are now. But historically, it's done about 6% per annum in the property market. So if you bought an investment, $500,000, 6% return, you're going to get to, and you start at age 20, that investment would be worth just over $5 million by the time you got to age 60. If you waited to 30 to start, well, that $500,000 investment at 6% is going to be worth about 2.7 mil. So just that 10-year gap is cost you close to $3 million, just about 2.5 mil. If you wait till 40, you'll get to about 1.6 mil. And if you wait to 50, you'll get to about 800, 900,000. So it's important. So understanding who you are, what your profile is, what's your risk tolerance, what's your cash flow. But please make a decision. Real estate, we'd love to time the market, but timing the market is not as important as time in the market. Time in the market historically shows that real estate performs well over the long run. It'll have its ups and downs. But again, you look back at properties, if you bought a property 20, 30 years ago, how much money have you made? And yeah, it's gone up and down and had good times and bad times. So time in the market is more important than timing the market. And why is the strategy so important? We've seen it over the years. People get excited about an investment property and they say, I'm going to get in the market, and they get excited about something that's, you know, sexy, as in development site. I'm going to get a development site and I'm excited. I'm going to be a developer. In 5 years, I'm going to bulldoze this property, and I'm going to build 3 villas, townhouses, or whatever that might be. And that sounds exciting. But the problem is people forget about the journey to get to that 5 to 7 year mark to do that. So if you go out and buy an investment property that's suitable for development in 5 years, more than likely it's going to be pretty run down, right? You only want to buy something that's largely land value to do that. So a rundown property, it generally means your rental returns are going to be quite low, so you're going to have a significant negative cash flow if you're borrowing 80%. It also means repairs and maintenance are going to be quite significant, because if you've got a tenant in there, there's certain things you have to do to keep that house functional and operating, and under the law, there's certain things you have to do. So it's going to be quite a cash drain. And the other thing too, who's going to live in a rundown property? It's not generally going to be a family in professional roles. It's generally going to be a bunch of students or people who maybe on the margins. Maybe the quality of the tenants may not be good. Some might be not great, but you're more likely to get the lesser quality tenants who are going to even look after that property. So all those things, and what we've seen over that time is people who get excited, then they get in all these headaches and they get out of the market. It wasn't the right property for them because they didn't do a risk profile. They didn't think about all those things that I just spoke about. They got excited, went in, and they got out of the market. And guess what? Within that 5 year period, they got out. They might have made a little bit of money, but most people, once they get out of the market from a bad experience, very rarely get back in, and they miss out on those opportunities. So why do you need a strategy? You need to understand who you are, your risk profile, and then you develop a strategy around that. So yeah, you might want to buy a development site, but maybe for you that might be the third property. Once you've got a few more passive ones under your belt that are good, solid earners, but they're not going to get you rich from a development. They're going to be just good, solid, passive investment properties. That might be the right way for you. And if you have a couple of them before you go into a development opportunity, you've seen some highs and lows, but you haven't had all that really negative cash flow and tough issues. And so that means you're more willing to be able to get through when you get that development site, understanding property more and buying that through the cycle, and you'll be able to deal with all those issues that come up. So again, make sure you understand your personality type, your investor profile. Interesting, when we did the survey, 2/3 of investors said they've got a property investment plan to guide them. But interestingly, only 1/3 actually wrote it down. So I guess the other rest of them have got it in their head. So I don't know, I find things up there. So I think they probably better on paper or on a computer because it's things change. So yeah, interesting. Yeah, a lot of investors have a plan, but it's just in their head. They haven't written it down. I recommend writing it down. So how do you form your strategy? Well, the way to do it is understanding who you are. There's a lot that goes into it. You can talk to our team about it. Your risk tolerance I spoke about, your cash flow, again, your ability to manage that negative cash flow, how old you are, taking more of a risk when you're younger. Do you want to take a big risk when you're 55, 60? Probably less likely. So how many dependents you've got, how many children, they're always, children are one of the big liabilities if you want to get a loan. So if you want to build a big property portfolio, maybe don't have as many kids, but that's a personal choice. There's lots of other things that go into it as well. So understanding your strategy is based on your investor profile. And remember, thinking about the long term. You really don't want to go into a property, again, with a 5 year horizon. It's really, with all the in and out costs, particularly with capital gains, and we know that they're talking about making changes there. Thinking about the long term, 10 years, 20 years, 30 years, our philosophy is you buy a great investment property. If you're 30, you'd be holding that right through until you get to that stage when you want to exit or start thinking about exiting a job, or you want to sell your business, thinking that far out. So long-term thinking and long-term investing. And you'll see through the cycle, there's ups and downs, and there will be, and guaranteed, the next 30 years there'll be highs, there'll be lows. But in the long run, if you buy good quality investment properties in a strong economy with good population growth, and Perth is forecast to be 3 million by 2035, and then I think we're going to be 4 million by about 2045 or thereabouts. So we've got to catch up to Sydney and Melbourne where they are now, certainly in most of our lifetime. So What does Perth still have for investors? Where are we sitting at the moment in the Perth market? Well, at the moment, we're forecasting 10% capital growth this year. It started off strongly. In the first 2 months, we're probably at 4% already. So, if anything, obviously there's a few things going on with rate rises and the like, and what's going on in the Middle East. But I still think 10% is probably going to be under where we end up. We did this forecast in November, and rents are still going up. We talk to our team every day in the office. What's happening in the rental market? Rents are still going up. And I'll tell you why. There's still more capacity in the system for that. And why have we gone up so much over the last 5 or so years? There's just nothing for sale. We had at a time in the economy where the building industry really slowed down, and we couldn't build. And then when the market turned, and the government threw money at all the new home builds, and then our population grew. One year we grew. The country grew 550,000 in population. We simply didn't have enough labour to build the houses. People came into the country. Guess what? The stock for sale has gone down. This is the lowest it's been in recorded history. So we went up to 3,000 this week. That's still nowhere near a balanced market. In the 03 to 07 boom, the lowest we got was 4,800. So even though we're 20 years on from that and a population 40+% higher, we are still, this is the lowest stock, not even adjusted for population. So that's the problem. We just have a lot of people looking for housing, can't find it. Balanced market's 13,500. At the moment, the houses are selling on average 8 days. Now, the balanced market would be about 30 to 35 days, so about a month just to 6 weeks. Somewhere in that sort of range would be where a balanced market is. Well, if half the houses are selling in 8 days, it tells you how strong it is. Robin was telling me just today, went to a home open last night, 8 offers on one, 9 offers on another. It's still very strong out there in the market. Rental market, similarly, come right down, 1,800 for rent or thereabouts. We need 6,000 to 7,000 rentals to get to a balanced market. And so right between those two, we're about 4,000, 4,500 short on rentals. We're about 10, 11,000 short on properties for sale to get back to balance. So if we would need to find 14,000 new properties tomorrow to get back to a balanced market. That's just in Perth. If you include the regions of WA, it's closer to 20,000. There is zero chance while we have 60,000 or 70,000 people coming to Perth each year, or Western Australia I should say, there is zero chance we're going to get anywhere near that, back to a balanced market in the next 5 years. Now, if we had a big economic downturn, yep, or a big cut in migration, yep, it still would take years though just to get back to anywhere near a balanced market. And the other thing too that underpins housing prices is replacement cost. So if you go back to 2019, you could go and buy a house and land package in the outskirts, Baldivis and all those outer suburban areas. You could buy one for about 450,000. You got a 350 metre block, a 3x2 or 4x2, 450,000 or thereabouts. These days, it's 800,000 for a house and land package. So that's the kind of the entry point in the market, and that everything then replacement. People go, because if replacement was 450 and established was 900, would you go, well, I'll go and build? But of course, when brand new is 800, well, people that's how they benchmark the rest of the market. So that's another thing that will keep prices solid, is the fact that replacement costs have come up so much, and we just all know that the time blowout, the bricklayers are still making really good money. I can't see that changing anytime soon with all the projects that are on in and around Perth, and we can't keep up with the demand. We're building roughly 22,000 homes a year or dwellings, but then we're actually bulldozing some as well. So the net is closer to 20,000. Now, if you have an average of 2.5 people per household, persons per household, that means that would accommodate 50,000 people. Well, the last year to date when the stats came out, we'd had 65,000. So we're going backwards even currently, let alone catching up that 14,000 shortfall in Perth and 20,000 across the state. So fundamentally, strong demand, limited supply. That's going to keep our prices moving. Demand, so, and I mentioned that just there, 65,000. We'd need 26,000 homes. We're building a net of about just on 20,000. So even in the last 12 months to the financial year 24-25, we went backwards another 5,000 properties. And this is a model that we have. We're basically tracking population growth versus supply. And it's pretty simple. It's supply and demand. You can see there when the orange bars are up that way, that's too many houses for the number of people we've got. And you look at the black line, you can see there when there was too many houses for the number of people in the state, the prices went backwards. But as soon as that started to turn negative towards 2019, we started to see a turn in the market. And of course, look at the last 5 years, negative, negative. When they're below the line, that orange line, particularly when it's a long way below the line, that means we're massively short on the number of houses that we're building for the number of people. And guess what happens to prices? It goes up. So it's not very complex. It's like commodities. It's like anything. Supply, demand exceeds supply, prices go up. And so who is Perth still a good investment for? Absolutely. Yep, everyone would have loved to bought 5 or 6 years ago, and I hope you did. But if you didn't and you think you're getting into the market, and you live here in Western Australia, we still see some good upside. Now, we're not going to grow at 80% like we did the last 5 years, but fundamentally there's still good opportunities here. It'll start to return back to more a balanced long-term growth rate. Might still take another year or 2 or even 3 before we slow down, but there is still solid capital growth here. We're a growing city, strong economy, high wages, so we still think there's good solid opportunities here in Perth, and particularly if you're not comfortable going anywhere else, we certainly still think that Perth's a good place to invest. Good tenancy legislation. I'll talk more about that in a minute. And yeah, if you're coming from, we're still getting East Coast investors coming over here, still buying, even though the cycle has gone a fair way. And interesting, in our investor sentiment survey, Perth was still quite appealing. Lots of people still want to invest in the Perth market. But if you don't want to invest in the Perth market, where else would you go? So we do a lot of research in this space when we're looking around, and here's what we call the property clock. Now, the property clock is not necessarily a perfect clock. It's basically the old traditional economic clock. We use it, but it's not perfect. But basically, it gives you an idea. So Adelaide, Brisbane, Perth, we think are up towards that higher end of the cycle. Sydney and Darwin starting a bit of an upswing. Darwin's come off for a really bad long run period of time, but we wouldn't invest there for reasons I'll explain. Melbourne is the capital city at the bottom of the market, or thereabouts at the bottom of the market. So that probably has more short-term upside than any other capital city in the country. Now, when I say short-term, it still may go nowhere this year. It still may sit there and be a low-growth city for another year, maybe even 2. But certainly where it sits in the market, that is at the bottom of the cycle, and we think has got the most opportunity for upside in the next, certainly in the next 5 to 10 years, and I'll tell you why. So, what do we look at? Strong economy is number one fundamentally, which really helps, because a strong economy means there's jobs and people move there. It means people feel confident and comfortable, willing to go into debt, willing to take investment and buy, whether it's a home they buy or buy an investment property. So surprisingly, Victoria only has a 4.2% unemployment rate. I think it's because the government's employing more than half of them. But the WA here, 3.4%. So people feel pretty comfortable about their job prospects. You know, if you didn't have a job tomorrow, more than likely you'd be able to get another one pretty soon. So yeah, fundamentally WA is strong. Even Victoria, not too bad on unemployment. Population growth, that's really critical to long-run property price growth. The bigger the cities everywhere around the world, the more people, the more the median price is, simply because more people demanding property. So Australia was 1.5% over the last year to June 2025. That's the lagging. The ABS is a bit lagging that data. We're now 27.6 million people. WA was 2.2% on average, just in that in that June quarter, and that's why, as I said, we're growing at 65,000. So, and interestingly, people move to WA, even though we know it's a great lifestyle here. People generally move here because of economic opportunities. They come here because they can get a job. They know, it's people, if they move for lifestyle, out of Sydney and Melbourne tend to go to Queensland because it's same time zone. People move here for job opportunities. So that is the biggest impact on our population growth, is that strong economy. And we've still got a strong economy, lots of people looking for labour. That means more people are still going to keep coming here. Government housing targets, interestingly, and we certainly did criticise that ambitious target. It was just a number plucked out of the air, 1.2 million homes. Great to have goals, but how are you going to get there? You can see in the first 12 months, or not even 12 months, 9 months, where we got to, the miles behind. Every state around the country is behind, and some, Queensland 32%, New South Wales 30%. We're not as bad actually, to only 20% down, but we can't build enough homes around the country with the population growth that we have. So this is also something certainly that goes into the mix of deciding where you'd want to invest. If the economy slows down, if you've got a strong state government that's in a good, strong financial position, well, they can invest counter-cyclically. So the best time to invest in social housing would be if the economy drops off, not now, from an economic point of view. So we all know here, thankfully, we've got our GST, or most of it, back. We're still giving them 20% or thereabouts of our GST, but at least we're getting that 80 or 82% now. That's helping underpin our budget. The forecast is 2.4 billion. It'll be another 4 or 5 billion surplus this year, guaranteed. So we're in the best financial position of any state by a long, long way. The East Coast are all miles in deficit, so that's a challenge. If their economy slows down, where is Victoria going to get the money? They've already got 180 billion of debt. How are they going to find more money to invest in infrastructure and capital works projects if their economy has a downturn? So that is something to keep in mind, that the government can't really underwrite any significant downturn in their economy. Cash rate, we know it went up today. This slide was done before today. Look, I always say, when you're investing in property, and we spoke about that before, about FOMO and fear of overpaying and what's going on in the Middle East, all these things, there's so much noise out there. I'm investing in property as you would be for 10, 20, 30 years. Who knows what are interest rates going to be in 2 years? I don't know, and no one knows. Anyone who tells you what the interest rate's going to be in 2 years is really guesstimating, because so many things could go on in this world. So why does this matter? It matters in terms of your own ability to afford a property, but I wouldn't be making investment decisions based on the fluctuations in interest rates in the short term, because none of us know where it's going to be in 2, 3, 4 years. We certainly know it's not going to get back. I do get some people say, oh, it's going to get 18%. That's not going to happen. If we had 18% interest rates, well, we almost would just hand back our keys to the bank, because we can't afford it. So it's not going to happen. Could rates go up a little bit more? Absolutely. But in the long run, it's all relative to inflation. Inflation is, picked up a bit. But then again, I read more and more stories about the ability of AI to reduce the cost of services. A lot of fee pressure coming on a lot of professional service providers. Things getting more efficient. So in fact, they're talking about deflation. So none of us know exactly where it's going to end up. So pay attention to interest rates, but it's more about whether you can afford it and you've got enough buffer if there's a little bit rise. But I wouldn't be making my long-term investment decisions based on what's happening in the cash rate month by month. So where are the markets at the moment? Here's what's happened over the last 12 months. You can see there to January. Sydney, pretty average growth, 6.4. Melbourne, 5.4. But they've both been slowing down in the last few months. The real performers have been Brisbane, particularly at 15.7, and Perth at 18.5. Darwin, 19.7, but I still wouldn't invest there. It's very much a government town and driven by government expenditure programs. If they pull back, there's not much of an economy up there. And so across the country, quite a varying rate of capital growth over the last 12 months, 18.5% in Perth, is pretty spectacular in the 12-month period. The rental markets still going pretty well. We're up 5% last year. We said 4% this year. I think, yeah, we're going to continue to see rent price growth with that housing shortage. And is there a barrier? I'll talk about where we sit in affordability in a minute. Brisbane, 8%. So yeah, rent prices are still growing just because there's not enough supply around the country. But interesting, the yields. You know, we were 5% yields 3 years ago. We're not anymore. But at 3.8% yield, we're still cheaper than Adelaide. We've got a better yield than Adelaide, Brisbane, Sydney. Melbourne is actually ahead of us, slightly in yield. So yeah, we've come back to the pack, but we're still a decent rental return. Housing affordability. This is an important chart. We say, well, people say, oh, gee, prices are up so much, rents are up so much. How can people afford to pay any more? Well, I know some people can't, but we look at system-wide, and this is stats from the Real Estate Institute of Australia, and they say, what is the median mortgage payment as a share of the median income? And in New South Wales, and that includes Sydney and other parts of New South Wales, 57.3% of a median salary goes on a median mortgage. So it doesn't mean everyone's paying 57%, but if you took the median salary or income versus the median mortgage, 57%. Rents are a lot cheaper at 27.6% of their income. Victoria, 44%. Queensland, 51%. South Australia, 48%. We're 43%. So yeah, we were miles below everyone else, and that's why we've had that strong run-up. But it's still cheaper, it's still more affordable to have a mortgage in WA than it is in South Australia, Queensland and New South Wales, and even Victoria, although we're getting closer to Victoria. So that tells me that, and why is that? Because our income is typically a fair bit higher than particularly South Australia, but in fact across all those states except the ACT, where the public servants get paid very well. So we still have capacity. Even if we went from 43%, you know, back, even if we caught up to Adelaide, South Australia, I should say, there's another means we could borrow effectively 10% more. So do people want to pay and borrow 10% more? No, they don't. But that tells us there's capacity in the system here in Perth, particularly in WA, and same in Victoria, 44%, New South Wales, 53%. So there's capacity in those markets. Same with the rental markets, they're all quite similar in the mid-20s. Victoria's slightly cheaper at 20.4%. So New South Wales has always been high, and it keeps still going up. So people just, as a city gets more expensive, people just spend more of their income on housing and tend to take away from some other, spending such as retail and hospitality. So what do you get around the country? Quite a difference in the types of properties that you get. In New South Wales, and I'll go through these quickly because we've still got a bit to get through. Bexley, a suburb, 14k out of the city, not a particularly flash suburb, 700-metre block, that's a bulldoze house. So that's 1.4 million for basically a block of land in Sydney, 14 kilometres out. It's our most expensive city by a long way. Victoria and Melbourne, Braybrook, out the west side of town, but that's rejuvenated over the years, 9k out. For 816,000, you get not only a similar sized block, but you also get a pretty nice, solid, renovated house. So again, substantially cheaper than Sydney when you get to Victoria. Queensland, actually dollar for dollar, is more expensive now than Melbourne. It's $1,050,000 in the city. This one here was just $1,050,000, right on the median price, 4x2, and that's what you got. It's an okay house, nothing so flash. So yeah, you're paying. Brisbane is pretty expensive, certainly compared to Melbourne. WA, Bayswater, actually quite a good suburb. We do like that suburb. It's right on those 3 train lines going through there now. $961,000 for that. In the median price, this is $1,050,000, 4x2 on a 470-metre block. South Australia, again, one of our other major cities. This is $1 million in South Australia, or Adelaide, I should say. I'm struggling to see how that can go up much more, but it's still going up, albeit at a lower rate than it was a year and a half ago, but there is still a shortage of housing there. So that market is still performing quite solidly, although not as strong as Brisbane and Perth. I won't bother you with Tasmania and NT and ACT because we don't invest there. So if you want to... so where is the next big investment opportunity? Perth, we still like Perth. Brisbane is good, but it has come a long way, but it's still growing in population. The Olympic spending is still going to be there in bucket loads over the next few years, and their economy is pretty strong. So the other one is Melbourne, and for some of the reasons I've alluded to, they're our three cities that we would suggest if you're going to go investing. If you want, obviously here in Perth, we've discussed Brisbane and Melbourne, but particularly Melbourne, when you look at all those factors we've covered today, Melbourne is the next market that we'd be saying you would want to go to. You've got to understand the markets though, so some of the challenges in Perth, no land tax if you buy on 300,000 of property. Melbourne, you are going to get stung land tax. They've put their land tax up rate significantly, so you've got to factor that into your budget. We've got a strong economy, strong government surplus here. We don't in Victoria, so if their economy takes a downturn, the state government can't do much because it's already got enough debt. We're still relatively affordable, but I would say Melbourne's more undervalued than we are here in Perth. But again, looking at that 10, 20, 30-year period, they're still good, both cities to invest in. It's a seller's market here. Melbourne's a more balanced market. It's particularly in the apartment space, it is a more balanced market. The tenancy laws here are not bad. Every Residential Tenancies Act does favour tenants, of course, but Victoria's are particularly brutal. You've got to be understanding those laws. You know, when we're looking at properties there, sometimes if you don't understand what you're doing, that you might end up having to spend 5,000 or 10,000 getting up to tenant ready. So be very aware of what all the requirements you have for a rental property. We're the fourth largest city. We're growing strongly, but Melbourne is still the second largest city, and that's, you know, it's a more diversified economy. We're undersupplied. They've got an oversupply of apartments, houses, more balanced. But we are a commodity export here, albeit we've got a broader variety of commodities in some cities around the world. Melbourne is a bit different. It's more heavily reliant on population changes, but also does have a broader economy. It's got, obviously, as I said earlier, students, financial services, and a more broader-based economy. So probably less volatile than ours. When we go down, we do go down pretty hard. So I'm just going to cover commercial diversification quickly as well, because I know we're getting into question time. Our philosophy is when you start investing, resi is the place you want to start, commercial is where you want to end. And the reason for that is you want cash flow. Commercial is about cash flow investing. Yes, you do get capital growth, and we've bought assets for one I was just talking to someone about today. We paid 11 million and we sold it for 30 in one of our funds. Yeah, we've had some great wins, but generally commercial property is more cash flow and income focused. Lots of different types of commercial property: retail, office, industrial, alternatives, medical. So, and they're all going differently. Industrial's performing well. Vacancy rates in some capital cities are less than 2%. If I go to office markets, vacancy rates in some capital cities are 20%. So it's not just a matter of, even within a commercial world, some of those asset classes perform quite differently. Industrial's about distribution. There's been still strong demand there. We like medical. Office we're very cautious about because AI and all these other things that might impact that market. So there's a lot of different things that go into all the different markets. So you don't just go commercial property, anything's okay. You've got to be very selective about what you're choosing. But of course people go, well, if I get into a commercial property, you know, it's expensive. It costs $1 million, maybe more. I'm at risk of a tenant, might have a single tenant. Well, there are ways to pool that money, and that's obviously what Westbridge does, but you can invest in a fund. So if you had $1 million to invest in commercial property, you potentially could go into 10 different funds of 100,000. Those funds might be single asset or multi-asset around the country. You might have access for $1 million, you might have access to 30 tenancies and maybe about 20 different properties across the country. So that, talking about diversification, investing through a property fund gives you that very broad diversification so that no one single property or one single tenant should have a significant impact on your property investment portfolio. Really hasn't taken off in residential. A few people have tried residential funds, but most of us like to go and buy it individually. But certainly in commercial, you can diversify away some of that and lower that risk because you can get access through property funds. And basis pooling, if you put 200,000 into a fund that raised 20 million, you get 1% of the income and you get 1% of the capital growth. And some of those funds do return 7+%. And can generate solid capital growth on top of that. So there's different types of investment. Some funds everyone can invest in. Some you have to qualify as a wholesale investor, and that's income of 2.5 mil or income of 250 or more, or net assets of 2.5. So be aware of that. You can't necessarily invest in all funds. You need to have an accountant certificate. What are the advantages? Commercial property, whether it's direct or through a fund, definitely higher rental yields, outgoings paid by the tenant, longer term leases, generally sometimes 5 years. We're looking at one today, buying 8 years a lease term. You get good tax benefits, but it's not a place you want to start. It's a higher price point. If you go on your own, you've got to generally have 30+% deposit. Lending rates are higher. We get really good rates because we have $500 million in debt across our funds, so the banks love us, and we get very competitive rates. But if you're going on your own and borrowing 800 grand, you're not going to get a good rate. You're going to certainly pay higher than a traditional residential mortgage, whereas ours are similar or even less in some cases to a residential mortgage. Values can be more volatile. That's why you want to make sure you're a bit more diversified, rather than putting all your eggs in one basket. But it does come with those higher risks. But as I said, spreading that across multiple assets is a way to help minimise or lower that risk. You never eliminate risk, but you certainly can minimise it. So what's the model portfolio? It's in the book, but this is our philosophy. You want to have if you want to live off the income from your property for life without having to tip into the capital, you want to be aiming 50% residential because you're still going to get capital growth at slower risk, 50% commercial. That should give you a net return of 4.5%, and that will hopefully grow in line with CPI for the rest of your life. If you're willing to take more risk, you might go to 10% in development, but predominantly you want to be focused on that income stream and live off the income. If you're just residential, you're going to find that you just don't have enough cash flow. If you had purely residential, let's keep it simple. If you had purely residential, you had 4 million of net investment assets without debt, you're only going to generate 120,000. If you had 4 million of just commercial, you would get 240,000. But because they've got different pros and cons, we say if you had 4 million in net investable assets, go half and half, you'll get 180,000 per annum. And guess what? If you don't get to that level, 4 million sounds like a lot, but if you start young enough, make the right decisions, you can get there. But if you don't get there, you can sell down some of those assets. You might sell one asset for $1 million and use the capital to live off, still give you that income stream. So look, that's it. I thank you everyone for that. I hope you enjoyed it.